Hey everybody, we're here with Emile from Counsel CPAs, and I've got to ask you, the new administration is coming in, and it is in. So tell us, what can we expect tax-wise with this new administration?
Hey Jodie, good to see you again here. Hard to say really what's going to happen and what will change. There are a lot of promises right now, and hopefully for the better. What we can talk about is what's expiring, like the provisions from the previous tax code that's expiring, and most of the provisions are from Trump's previous changes that he made. He made a total overhaul of the tax code back in 2017. That's been kind of dragging with us along to end of 2025. So what we know is that a lot of those provisions are expiring, and we can talk a little bit about those provisions right now and maybe plan around that. I don't know. I would lie if I would tell you I know what's happening, but let's talk through some of the major things that are expiring by end of this year, so we can kind of prepare and get ready for what to come. Does that mean that this will remain the way it is? I don't know. Maybe next week we get a notification from the IRS that the entire tax code changed. But we'll probably hear about it in the news and everywhere else. So we'll get back and update everyone with anything that will change. But let's talk about a little bit what will expire if nothing happens. Assuming that will just continue and nothing happens, we will most probably ending up paying more taxes because a lot of the tax savings and the code sections that were benefiting a lot of small businesses, law firm partners, are expiring. Just as a simple thing, let me just share my screen real quick with you so we can see what's happening here. Bam, bam, bam. This should do it. All right. So real quick, this is interesting to look at. This is the tax brackets in a different kind of income levels. If we look at this kind of a tab here, for single taxpayers, this portion is for merit filing jointly taxpayers. And if you are in between these income rates or income brackets, you will end up paying this much in taxes. This is the first portion is what we're paying right now. The second portion is what we will end up paying if nothing happens and the provisions will expire. So if we look at it, 10% bracket taxpayer are not going to end up paying more taxes, but that's very low income taxpayers. But as the income grows, 12% will increase to 15%, 22% will increase to 25%, and all the way up to 37% right now will end up paying 39.6% in taxes. That's a significant increase in taxes for high income taxpayers. One extra thing that I want to mention here is if you look at just single versus merit filing jointly income brackets, if you look at the top brackets, the top amount, 11,000 compared to 23,000, that's pretty much a double, right? That's a double amount. And that's the case all the way up to 33% taxpayers, that 33% bracket taxpayers, which is, if we look at here, 243 is about 487. But that changes for 35% and up brackets. If you look at the 609, increases only to 731,000 for merit filing jointly versus single payer. What does that mean? That means that basically IRS is penalizing married couples. Why is that? I don't know. So a lot of times it doesn't always make sense to get married on paper for tax perspective. So this is what I call the marriage penalty from tax perspective. There are other penalties by being married, but that's a discussion for another time. But be careful with when you're making a decision on getting married or not. If both taxpayers are making significant amount of money, and both you might end up paying more taxes as married couple versus two single people. That's
So,
just the
now, would you say that if you are in one of those higher tax brackets, that you may even suggest filing differently this year?
No, it's not about how you file. It's a
Okay.
matter of what your marital status is. So if you're married, you can't file as a single taxpayer
Okay.
unless you don't live together and you're separated and all that. But typically, if you're married, you live together, you don't have the choice to file as single taxpayer. You could choose to file as married filing jointly or married filing separately. The married filing separately bracket is not on this page here, which is a lot worse than the married filing jointly and the single taxpayer bracket. So I would not recommend you to file married filing separately. 99 out of 100 times that's my recommendation. But you might want to consider whether you want to get married on paper or not if you both spouses are making significant amount. That would be my recommendation.
Okay, that makes sense.
All right. So what else is changing? Real quick, your standard deductions. So if you don't have a home, if you're not taking a mortgage interest deduction or property tax deductions, your standard deduction for married filing jointly will go down from about 30,000 to 15,000. So not only that, the brackets are going up. You're paying more taxes from the higher tax bracket perspective, but also your standard deduction is going down, so you're ending up paying more taxes from that perspective as well. A big topic right now, which has been on the platform to discussion, and is the SALT limitation. SALT stands for state and local tax. State and local tax. So historically, you've been able to deduct your state and property taxes on your federal income tax return without a limitation until 2017, where Trump changed the tax code with his total overhaul. He put a cap on the SALT deduction for up to $10,000. So that means that if you paid state and property taxes more than $10,000, it was capped at $10,000. You could not deduct more than that. And states like California and New York, where we have pretty high state taxes, you're reaching that $10,000 very quickly, especially if you own a home. In California, you rarely find a house for under $1 million, and the property tax is about 1.25% of the purchase price, or so your property tax would pretty much cap out your limitation. But it's a discussion now that they want to increase the limitation to at least $20,000. Don't quote me on it yet. We don't know anything yet. We don't know if that's going to increase, if they're going to stay the same, or they might even just remove the limitation altogether and go back to what we were before, where we could deduct with unlimited amount. That's actually a benefit. That's not going to hurt us. That's going to save us taxes because we can deduct more in taxes. All right. That said, California and 35 or 36 other states had a workaround for this SALT limitation via the PTE tax deduction. PTE as pass-through entity. What are pass-through entities? S corporation, LLCs, partnerships, those are all pass-through entities. So if you're running a business as a law firm, as an LLP, typically as an LLP in California, other states can run it as a professional LLCs or an S corporation. Those are all pass-through entities. 35 or 36 states, one or the other, because they keep adding them on. California is by the way, one of the first states that implemented the PT tax deduction, and was for first 7 states, and thereafter has been gradually other states have been taking after. And what is this PT tax deduction? Basically, it's a work around the SALT limitation that we just recently discussed. It allows business owners with pass-through entities such as LLP, LLCs, S corporations to deduct their individual state taxes, which they were able to deduct on their individual federal return before this limitation. Now they're able to deduct it through their business entity, through their LLP, LLC, or S corporation. Just to give you an example of how the calculation works, each state have its own little calculation, but California, for example, you could deduct up to 9.3%, or not up to, sorry, you can deduct 9.3%. You don't have a choice. Either you do the full amount or nothing. So 9.3% of your state business income. As an example, you make $1 million profit on your state tax return through your LLP or LLC or an S corporation. Out of that $9 million, $1 million, $1 million, you can pay $93,000, which is 9.3% of the $1 million in your from your corporation or your LLC or LLP, your pass-through entity, to deduct it from your business income. That's a fantastic benefit, because that's a payment that you would anyway have to pay via your personal account, but now you're just paying it through your business and getting a deduction for it. Whether it's for you get a deduction for it because it's now it's a business expense, not an individual tax expense. But it's still the same thing. You get applied towards your individual taxes and take same benefit as if you paid individually, but the extra benefit is that you will deduct it. There's a fantastic deduction here, and on $1 million example, just a rough example, you could save about $35,000 in taxes by just paying it with the right side of the pocket. Instead of paying it from your left side, you're paying it from the right side, if it makes sense.